Well, more money in the hands of the consumer hopefully also means better credit revival. So let's go back to the banking financial services space and let's talk to the management of AU Small Finance Bank. The reported numbers, stocks higher, 20% year-on-year growth, 6% quarter-on-quarter growth, healthy growth in the secured portfolio, including mortgages. And there is a lot to talk about here. Sanjay Agarwal is founder and managing director, CEO at AU Small Finance Bank. Sanjay, good morning. Good to have you with us here. Prashant, this side.
Yeah, Prashant. Good morning.
Good to see you.
Good morning. How are you?
All well. Thank you.
Yeah.
The question is about, we were looking ahead, right? We just had a discussion at 9:30 with Mr. Dinesh Khara and Mr. Chadda on all of the regulatory relaxations with regards to liquidity we've seen from the beginning of the year, and things seem to be much better. But let's talk about your business. We've seen healthy growth. What can we expect in terms of growth for FY26, Sanjay? And also give us a sense on asset quality. Do you expect some challenges to persist, at least in the first half of 26? Go on.
Yeah, Prashant. So again, thank you for this opportunity. So let's go back, last year when we all started 24-25, we never felt that, we'll go with this tough year, the challenging year. So in my opinion, we were not prepared, because we all forecasted 7% GDP. We all thought that there will be enough liquidity, inflation will be under control and all those things. But somehow, last year remained very tough in all sense. Our GDP never performed. Broken momentum, I would say consistent liquidity issues. So I think from last 2 months, things have changed dramatically, in my opinion. And I would give credit to the regulator and, of course, the government itself that the focus on growth is back. But I think we need to also figure out that we are just forecasting a GDP of lesser than 6.5 for this current financial year also, right? And we are just starting this year. So to build anything from here and give you guidance at how much growth can happen and how this year would not be right at this moment, in my opinion. We need to wait actually how it's actually pan out. But I personally believe that this time we are well prepared, because I'm a cricketer. I know that if pitch is if you don't able to estimate the picture, then you can't able to perform.
No, that point is taken, Sanjay. Yeah. That point is taken. That last year we started on a high note. The economy itself, policymakers, everyone were on a jubilant note, and therefore not prepared for what followed. But now we are prepared for the worst because of whatever Trump has done, and therefore perhaps we'll do better. But let us just do the little bit of math that Prashant was asking you. Are we going to see an improvement in margins? Everybody's margins fell in FY25 because liquidity was tight and interest rates are getting cut. This year, because of liquidity, does 5.8 go towards 5.96? How do margins go?
No, so there I would say that still very early time. There is a narrative from the regulator that they will put liquidity and all those things, but the real action has to happen, right? So for me, the real interest rate correction or a margin expansion maybe in Q3, Q4, but I know that it will be in next financial year, that's for sure. But this year, I want to take a very guarded approach that, let's not build anything from this initial initiatives, let's see, go more deep in the year, build your organization or a bank around these challenges, So I would say that ideally I would love to say you that, there can be a margin expansion, but I also see the reality so that holds me back.
Should you need to,
Sanjay, all good time, right?
Got it. Sanjay, one of the things that analysts have been we've spoken with has said is that on margins, you will need to offer higher rates as compared to other lenders to attract deposits, and that may keep margins under some pressure. Is that a reasonable point of view?
Of course, and it's true in our case, Prashant, because we are a small finance bank. We are still not that in big league. Once we go to the market, our team gets a lot of questions around our SFB platform and all those things. So we need to price even by basis of 25 bips, And in our whole maths of ROA, 25 bips is a huge amount, right? So that's why I'm saying you that, these are the initial time, just happened in last 2 months. So let's go more deeper and let's see how the whole liquidity, actually reality happens, on the ground, because liquidity in the bank, at the bank platform or at a platform of consumer is different, right? So let's see how the liquidity is at the consumer end and how he able to build their deposits with bank and all those things. So need to see this in maybe couple of quarters. Then we will able to say this that what is the margin expansions, how we can pan out our whole year.
Yeah, get that, Sanjay. We don't have too much time, so if I can rush some more questions.
Yeah.
What Prashant and I are trying to ask you is, does it go to 5.7 or 5.6 and then rise in the second half? If you can give us some direction.
Honestly, Latha, difficult. Whenever we have gone in this kind of uncertain time, it's difficult. Something happened in next 1 month. Who will actually will figure out that, how the real things happen? Because if you ask me in April, there is a softening of interest rates, in wholesale deposits. But if you ask me on the retail side, it is never happened at all as of now. So
all right.
All right.
Let's shift gear to asset quality question, which we couldn't attend to at all. Can you just take us through whether you saw any improvement in MFI? When do you see it improving? You've taken a huge credit cost, almost 2.5%. I think you're providing 100%. Correct? So give me some idea of the actual behavior on the ground in terms of collections and asset quality and your reasonable expectation for next year.
So Latha, last year, there were two challenges, both on the margins and of course the credit cost, right? But I strongly believe that this year our credit cost will help us more to build our ROA. So I expect a reduction in credit cost this year, and I'm saying because we are well prepared. We know that how our retail asset, which is the book of us, is around 0.90 kind of credit cost, which may go down to 0.8 this year. Commercial banking is largely around 0.4. It may go down to 0.3. Microfinance, already I have seen the improvement in the Q4. So I believe that we have a credit cost of around 7.7 last year. This year, we expect to be around 4%, right? So I think overall, I would say the credit card, of course, we are actually going in a course correction, and we'll do a lot of things so that our credit cost gets capped somewhere in 10% in the range there. So overall, I strongly believe that this year, this financial year, 25-26, the credit cost should be in the range of 0.9 versus 1.3, which we had last year.
So MFI stresses, we've seen the worst, Sanjay?
Yeah, that's my sense. And Prashant, again, I will say that we are well prepared. We know that how the GDP will have, what GDP will we have this year, how the whole momentum will be built. We know that there will be heat wave in the 2 quarters, then there will be momentum built in the second half, all those things. So this time we are well prepared, and once you are well prepared, you can manage not many things.
The sense I'm getting, Sanjay, from you is you are well prepared for slower growth. Last year we got slower growth. This year also what you said, right? Forecasts are for sub 6.5%. Is that the way to read this overall? Yeah.
No, Prashant, I don't want to go with a prejudiced mind that everything has become good. There is a push for growth. I want to actually wait and watch the entire spectrum. Play the ball when it's been delivered, right? So that sense, we can actually. In this last year also, Prashant, we have grown our deposit by 27%, loan asset by 20%, So in that tough time also, we have grown so well, right? So, but, the idea is to not to commit yourself in your team that we need to do this, irrespective of the condition, right? So the idea is to really be more balanced in your approach. And play your inning, with the environment.
Sure, absolutely. No, I understand that for your teams, maybe you don't want to put undue stress and put a number to to their head. Yes. But from a shareholder perspective, sort of rough ranges help to map the year ahead. So let's talk FY26.
We committed that if India grow by whatever nominal GDP will grow by at least 2 times to that, right?
Okay.
So 2 times of nominal GDP. So, we should expect growth in double digits. Just on the MFI part, You said the worst is behind. Our team is just, seeking a clarification specifically on Karnataka. Your issues in Karnataka that you are facing, are you past the worst there as well?
Yeah, so I would say March has given us hope because in March month, the OD recovery there is around 98%, right? Which was around 95 in the January month. And I'm not seeing many noises from that market now. So, and that is only a 10% of our book. So even we have counted that book in our current year planning, right? So I don't think Karnataka would play a spoil sport for us this year.
All right, got that point. Mr. Agarwal, thank you very much for joining in and giving us a perspective on the business. That's AU Small Finance Bank. The stock is doing really well, 5.5%.